In January 2022, FTX was valued at $32 billion. It was the crown jewel of crypto, backed by elite investors, endorsed by celebrities, praised as the safest exchange in a volatile industry. 10 months later, it collapsed in less than a week. Withdrawals froze, billions vanished, bankruptcy followed. One of the largest financial implosions in modern history unfolded in real time. ACT1. The rapid rise. Sam Bankman-Fried did not look like a Wall Street titan. He wore cargo shorts, slept on a beanbag, spoke in dense bursts about effective altruism and probability theory. But behind the image was aggressive ambition. Before FTX, there was Alameda Research. Founded in 2017, Alameda was a quantitative crypto trading firm. It exploited price differences across exchanges, arbitrage at scale, high-frequency trades in a market still immature. Crypto volatility created opportunity. Alameda generated enormous profits during the 2017 and 2018 cycles. In 2019, Bankman-Fried launched FTX, a cryptocurrency derivatives exchange. The pitch was simple: build a more sophisticated trader-friendly platform, faster matching engine, advanced products, lower fees. FTX grew quickly. It catered to professional traders first, then expanded into retail, futures, options, leveraged tokens. The crypto market entered a historic bull run in 2020 and 2021. Bitcoin surged from under $10,000 to nearly $69,000. Retail money flooded in. Institutional capital followed. FTX rode the wave. By mid-2021, the company closed a funding round, valuing it at $18 billion. Investors included Sequoia Capital, Paradigm, and Tiger Global. In early 2022, another round pushed valuation to $32 billion. It was one of the fastest value creations in startup history. FTX bought naming rights to the Miami Heat arena in a $135 million deal. It signed endorsement deals with Tom Brady and Gisele Bündchen. Steph Curry became a brand ambassador. Super Bowl ads aired nationwide. The message was clear. FTX was not a fringe crypto exchange. It was mainstream, institutional, trusted. Sam Bankman-Fried testified before Congress. He positioned himself as a responsible actor in an unregulated space. He spoke about risk controls, transparency, consumer protection. As other crypto firms faltered in early 2022, FTX played rescuer. It extended credit lines to struggling companies like BlockFi. It acquired distressed assets. Bankman-Fried was portrayed as crypto's white knight, but beneath the surface, the structure was fragile. Act 2. The structure. FTX and Alameda Research were separate entities. On paper. In reality, they were deeply intertwined. Alameda was one of FTX's largest market makers. It traded heavily on the exchange. It had privileged access to liquidity. The key was a token called FTT. FTT was FTX's native token. It offered fee discounts and other benefits on the platform. But it also became a financial instrument. FTX held large amounts of FTT on its balance sheet. Alameda held even more. The problem was concentration. Much of Alameda's balance sheet consisted of FTT and other illiquid crypto assets. According to later reports, billions in assets were tied to tokens that FTX itself had created or heavily influenced. If FTT's price fell sharply, Alameda's balance sheet would weaken. If Alameda weakened, FTX was exposed. The structural risk was not obvious to customers depositing funds on the exchange. Even more critical was the alleged transfer of customer funds. FTX customers believed their deposits were segregated, that their crypto assets were held safely, not lent out, not rehypothecated. But according to later bankruptcy filings and criminal charges, billions of dollars in customer funds were funneled to Alameda to cover trading losses and risky bets. This created a silent liability. As long as customers did not withdraw en masse, the system held. But if confidence cracked, liquidity would be tested instantly. Crypto markets operate 24/7. There is no circuit breaker, no closing bell. ASET 3, the trigger. On November 2nd, 2022, CoinDesk published a report. The article revealed details about Alameda's balance sheet. It showed that a significant portion of its assets consisted of FTT tokens, billions in value tied to a token closely linked to FTX itself. The implications were explosive. If Alameda was propped up by FTT, and FTT depended on market confidence in FTX, then the system was circular. Within days, Binance CEO Changpeng Zhao announced that Binance would liquidate its holdings of FTT due to recent revelations. The statement was brief. The effect was immediate. FTT's price began to fall. Traders reacted. Customers grew nervous. Withdrawals accelerated. In just 72 hours, FTX faced a bank run. Customers requested billions of dollars in withdrawals. Estimates later suggested over $5 billion were withdrawn on November 6th alone. FTX did not have the liquidity. Social media amplified every rumor. Screenshots of frozen balances spread rapidly. On November 8th, Binance signed a non-binding letter of intent to acquire FTX's non-US operations, citing a liquidity crunch. For a moment, there was hope. The next day, Binance walked away after reviewing the books. The reported hole in FTX's balance sheet was too large. What had been a liquidity problem now looked like insolvency. AST 4. The collapse. On November 11th, 2022, FTX, Alameda Research, and more than 100 affiliated entities filed for Chapter 11 bankruptcy protection in the United States. Sam Bankman-Fried resigned as CEO. John J. Ray III, the restructuring expert who oversaw Enron's liquidation, took over. His initial assessment was devastating. He described a complete failure of corporate controls. He stated he had never seen such a lack of reliable financial information in his career. Reports suggested that up to $8 billion in customer funds were missing. There were no proper accounting systems, no independent board oversight. Key decisions were allegedly made through encrypted messaging apps set to auto-delete. Alameda had reportedly received a secret exemption from FTX's liquidation engine, allowing it to maintain negative balances while other customers would have been liquidated. The firewall between exchange and trading firm did not exist. Investors were stunned. Sequoia Capital wrote down its entire investment, roughly $214 million, to zero. Pension funds, venture firms, and retail investors faced heavy losses. Crypto markets plunged. Bitcoin fell below $16,000. Confidence across the industry eroded. Bankman-Fried was arrested in December 2022 in the Bahamas and later extradited to the United States. Federal prosecutors charged him with fraud and conspiracy. In 2023, he was convicted on multiple counts. 1 week, FTX was a pillar of the industry. The next, it was bankrupt. ASET 5, the real reason. FTX failed. FTX did not fail because crypto is volatile. It failed because governance collapsed. At its core, the company concentrated power in a small inner circle. There was no independent oversight strong enough to challenge leadership. Risk management systems were reportedly inadequate or bypassed. Customer funds were allegedly commingled with proprietary trading activities. That is a foundational breach in finance. Trust is the currency of exchanges. Without it, liquidity evaporates instantly. The structural weakness was leverage hidden behind complexity. Alameda's exposure to FTT created circular dependency. FTT's value depended on market confidence in FTX. FTX's stability depended on Alameda's solvency. Alameda's solvency depended on FTT's price. When the token fell, the structure cracked. But the deeper failure was transparency. Traditional financial institutions are heavily regulated. They face capital requirements, audits, reporting standards. FTX operated in a loosely regulated environment. Investors relied heavily on reputation and growth metrics. Valuations soared to $32 billion without the scrutiny a bank of similar scale would face. Charisma substituted for controls. Rapid growth obscured structural fragility. During bull markets, rising asset prices mask risk concentration. When markets turn, leverage is exposed. The collapse happened in days, but the vulnerabilities accumulated over years. Finance runs on confidence. Confidence runs on credible information and enforceable rules. When customers clicked withdraw, they expected their assets to be there. They weren't. FTX's implosion was a reminder that innovation does not eliminate financial gravity. It can accelerate it. $32 billion in valuation, billions in venture backing, endorsements, stadiums, political influence, and then a week in November. Liquidity dried up. Trust dissolved. The system failed. In markets built on leverage and belief, confidence is everything. Once it breaks, nothing moves faster than collapse.